If this is protracted, that's bad news for energy markets globally and risk assets like equities.
Lochlan Halloway, welcome to the business.
Thanks for having me.
Investors appear to be waking up to the big economic risks that are posed by the escalating conflict in Iran. The market's down about 8% since the beginning of March, perhaps 2% for the week.
Well, I think the longer this drags on, the harder it is to see a fast resolution here, which was initially what was, I suppose, promised by the US administration. This is now dragging on weeks and weeks. That sort of 4 to 5 week initial timeline is looking less clear and perhaps less unlikely. If this is protracted, that's bad news for energy markets globally and risk assets like equities.
In spite of the falls we've seen, investors are fairly resilient, though, in the face of what looks to be like quite a big potential oil shock.
Yeah, I think that's right. I mean, investors are largely looking through this. I think most people in the market still have something like this sort of 1 to 2 month war as the base case, which might be a reasonable base case, like the huge global oil shock, long-term closure of the Strait of Hormuz is probably more of a tail risk. But nonetheless, we do have a sense of optimism that could be checked if this drags on longer than anyone expects, or we see really sustained infrastructure damage to Gulf oil.
And I mean, the oil price is really in focus. Brent crude went on a really volatile ride on Thursday night. I mean, it was up as high as $119 a barrel before coming back to about 107 or so. It's a big range to trade in one session.
It is, and it's been whipsawing for the last few weeks now as we get little dribs and drabs of news flow coming in about, you know, the status of the Strait of Hormuz, of course, being that very important maritime choke point for energy, but also damage to infrastructure in Qatar and Saudi Arabia and how that might affect oil supply longer term, not just in the short term. That's just reflecting how the news flow is changing almost hour by hour at the moment around energy markets.
And I mean, gold traded in a big range overnight as well. What does that reflect?
Yeah, well, the gold weakening is an interesting one because, I mean, generally gold does well in times of geopolitical uncertainty, but what gold doesn't like is high rates, high interest rates, because of course you don't earn a yield on gold, so the opportunity cost of holding gold starts to increase as other yielding assets, the yields on those assets rises. So that's been part of the pullback in gold, which has had a very strong run nonetheless in the last few years. Yeah,
and we'll get to that interest rate story, but when it comes to energy, there's quite a bit of concern about the supply outlook. I mean, European gas prices spiked, and that was after QatarEnergy CEO said its LNG capacity will now be about 17% lower in terms of exports over the next 3 to 5 years because it has to repair damaged infrastructure.
Yeah, and that's the big challenge at the moment. I think markets are starting to grapple with more and more. Initially, maybe it was just that there was this constraint on the Strait of Hormuz and that it wasn't going to let energy out for a temporary period until we had a resolution to the war. If we see big damage to things like this Qatar LNG plant, that's a problem that could last years. You know, supply could be impaired or totally offline for years now for some of these facilities, and that's a much more difficult thing for markets to grapple with.
And those inflation fears are really building. I mean, bond yields spiked, and we've also seen a number of central banks meet this week with some fairly hawkish commentary coming out of all of them, and interest rate expectations now are rising globally, not just here.
That's right, and I think, you know, people with long memories or students of history might think back to the 1970s and recall the stagflationary period caused then by an oil shock. There's many reasons why this one might be different, but I think we have to be conscious of the fact that when we do have a massive supply squeeze, that goes into measured inflation very quickly through petrol prices and through oil prices. When you have that colliding with what's already fairly buoyant conditions in the economy, like in Australia here, where we were seeing a turnaround in private investment and generally speaking tight labour markets, that does present an upside risk for inflation here, but globally as well, as you point out.
And petrol prices weren't the reason that the RBA raised interest rates to 4.1% this week, but they're certainly a future concern of the RBA.
Absolutely. I think, you know, the way we characterised that meeting and that result was that it was primarily a domestic issue. The case for a rate hike had been building well before the initial strikes on Iran. We do have a relatively tight labour market, as the governor's pointed out. Generally speaking, things are improving, continue to improve. We're running into that speed limit, that productivity speed limit that we've been talking about for a while now. This is another risk on top of that and strengthens the case, but it was already there before this.
So the outlook for interest rates, according to financial market expectations now, is that the cash rate will be at about 4.75% by the end of this year. That's almost 3 more interest rate hikes from here.
Yeah, look, it's worth pointing out that those futures implied expectations of the cash rate swing around wildly, and that could be very different in a couple of days or a week, so don't take it as gospel. That's what the market sees right now. I mean, that would be obviously a big constraint on spending power for many households in Australia who will see a big increase in their mortgages if that universe plays out. We do need to see a resolution, I think, in how this conflict in the Middle East unfolds before we would really, I think, bed down that sort of a rate hiking probe.
So long-term forecasts are out of the picture at the moment. Should traders or people investing be looking more short-term for those types of predictions?
I don't think so. I think it's generally good practice to keep the focus on the long term. This might play out in a month or 6 months or a year or 2 years. We don't know. Nobody really knows. And I don't think it's great sense to be trying to time markets to jump in and out. Looking at your portfolio holistically, does it meet your needs? Is it diversified to many different outcomes in the world? It's probably good sense in times like this.
How does a higher interest rate environment play out on an equity market, though? Investors typically don't like higher interest rates.
No, of course. Businesses don't like them, consumers don't like them, and equity markets don't like them. I suppose the question is, well, we already have many rate hikes priced in domestically, and we're also seeing fewer cuts priced in the US, for example. So I guess it's what changes about the outlook and how that might impact markets. What's already priced is kind of already in equity prices today.
Lochlan Halloway, thank you so much.
Thanks for having me.